Welcome to High Rock Capital Private Client Services. My name is Scott Tomlinson, and I am one of the two managing partners at High Rock. I'm going to walk you through an introduction to High Rock and a few of the key concepts behind what we do for our private clients. High Rock was founded by our other managing partner, Paul Tepsich, in 2010 to manage 4 funds for Scotiabank. High Rock is registered with the Ontario Securities Commission. I joined Paul in April of this year to help build our private client business, and we are 100% employee owned. We are excited to have our unique business model already making an impact. Our clients are coming to us because they trust in our patient, no-nonsense approach to low-cost investing and wealth management. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. We are not brokers, we are not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Importantly, all of us at High Rock have all of our money invested in the same models as all of our clients. Whatever we do for all of us. Our interests are aligned with yours, so there is no conflict of interest. Our fees are simple and transparent, and we fully disclose any hidden or embedded fees, and that is something that may not be the case with most investment advisors. In fact, we can keep our costs down because we do not outsource portfolio management, as many advisors do. As we have come through a cycle of average portfolio returns over the last 6 or so years, we expect that we are now entering into a period of below average returns. That will bring us back to the average. This being the case, it is really important to pay attention to the costs of investing. Fees truly matter. If you look at the impact of fees over time, it can be astounding. And more importantly, you need to ask yourself, what are you paying for? At High Rock, you get a wealth forecast by our certified financial planner, disciplined, active, tactical portfolio management, which you do not get with many advisors. We also have my daily blog and our weekly webinar to keep you current on our thinking, quarterly reports, and as much interaction with the portfolio managers as you wish. Very few fund managers, if any, will talk directly to clients. When markets get volatile, we want to be in touch with all of our clients individually to let them know that their portfolios are going to be okay, because we care. And we really do care. That is why we are in this business, to look after you. That is what you are paying us for. And importantly, we actually enjoy looking after you. It is easy for an investment advisor or portfolio manager to get you fully invested after you sign up with them. They sell the securities that you had and put you into investments that they want you to have, and they do it immediately at whatever prices are available at that moment in time. That is easy work for the advisor. It is a great deal more work to pick the right purchase points. Sometimes it may require patience and some explanation. In fact, some assets may take months and even years to get into a portfolio. As a result, risk management becomes very important because we must be vigilant not to put our clients' money at risk in order to chase higher returns in the short term, but take a long-term view to make sure that clients get invested at the appropriate time. Part of the discipline that we bring to the table is in picking the appropriate price points for buying new assets. This is part of the value that High Rock adds to our client portfolios. There are many risks that we have to focus on an ongoing basis. The goal in managing all of these risks is to reduce overall volatility in our models and our portfolios. Our ongoing efforts for the management of your portfolio strategy is to find the best possible returns while simultaneously providing the least amount of risk in doing so. Naturally, this is done in the context of each of our clients' specific goals and their tolerance for risk as we determine in your personal wealth forecast. Our research shows that a globally diversified and balanced 60% equity, 40% fixed income model can significantly reduce risk and still achieve an annualized return of somewhere between 7 and 8% over a multiple year period. This is what we consider to be the optimal portfolio. Rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling outperforming assets and buying underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform. This is how profitability is realized and the new cash reinvested. Our discipline is our strict adherence to your goals-oriented investing, our structured models, protecting your capital, regular rebalancing, in-depth research, fiduciary responsibility, and a very high level of client service. Building trust is never an easy task, but it is the most important aspect of what we do, and this we do not take lightly. We have a combined experience of 73 years. We have the highest accreditations in the industry, and our level of expertise is deep. Trading billions of dollars in securities with various banks and investment dealers has taught us a great deal about the management of risk. Not many investment advisors have this background. We follow the highest code of ethics and fiduciary responsibility. We fully disclose our fees and any embedded costs. We contract a compliance expert to provide an independent review. We have continuous and regular communications and avail ourselves for one-on-one discussions if you wish. There are very few firms in the investment industry with portfolio managers who will do this. At High Rock, we have three models with which we can create balance and diversification. A fixed income model with government and investment-grade corporate bonds, and a small percent may be high-yield corporate bonds, and we may include a selection of preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations. As well, we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research. This is an active or tactical model intended to obtain better than average growth. For our clients, we use these models to create portfolio strategies that are in keeping with your desired goals. Based on your wealth forecast, your goals, time horizon, and risk tolerance, we can create any combination of our three models to match your portfolio strategy needs of balance and diversification. For example, my strategy of 60% equity and 40% fixed income is built with 50% of our global equity model and 10% of our Canadian tactical model, as well as 40% of our fixed income model. However, Paul's portfolio is made up of 25% global equity, 25% Canadian tactical model, and 50% fixed income model. Depending on your needs, a more conservative portfolio might consist of 35% global equity, 5% Canadian tactical, and 60% fixed income. As I said, any combination can work if that is what your strategy needs. For your safety and protection, your accounts are held at Raymond James, who provides custodial and back office services for High Rock clients. Raymond James is a member of the Canadian Investor Protection Fund, which covers customers of members who have suffered or may suffer financial loss as a result of the insolvency of a member. If you'd like to learn more about High Rock Private Client and discuss any of this in more detail, please feel free to contact any of us by phone or email using this contact information. Thanks for taking the time to listen in, and I hope that we hear from you soon.